Understanding the stock market, a beginner's guide. Introduction. The stock market can be a daunting concept for beginners with its complex terminology, fluctuations, and seeming unpredictability. However, it plays a crucial role in the global economy, acting as a marketplace where companies can raise capital and individuals can invest in those companies. The stock market is not only a way for investors to make money, but also a reflection of the economic health of a country or region. In this guide, we will take a deep dive into the stock market, breaking down its components, how it operates, and how a beginner can start investing. Understanding the stock market can help you make informed financial decisions and become more comfortable navigating this essential part of the global economy. What's the stock market? At its core, the stock market is a collection of markets and exchanges where stocks, also known as shares, of publicly held companies are bought and sold. The primary purpose of the stock market is to provide companies with the ability to raise capital by selling shares to the public. Investors, in turn, buy shares with the hope that they will increase in value over time, allowing them to make a profit. This section explains what the stock market is, how it functions, and the importance of stocks in the financial ecosystem. The basics of stocks. To fully understand the stock market, it's important to know what a stock is. Stock represents ownership in a company, and when you buy a share of stock, you essentially become a part owner of that company. In return for owning stocks, investors may receive dividends, a portion of the company's profits, and ideally see the value of their shares increase as the company grows. In this section, we will define what the stocks are, how they are issued, and the different types of stocks, common vs preferred, that investors can purchase. How does the stock market work? The stock market operates through exchanges where stocks are bought and sold. The most famous exchanges include the New York Stock Exchange and the Nasdaq. These exchanges act as the platforms where buyers and sellers meet. The stock price of a company fluctuates based on demand and supply, with prices rising when more people want to buy the stock and falling when more people want to sell. This section will explain how the stock market works, including the roles of stock exchanges, brokers, and market makers. We will also discuss the concepts of bid and ask prices, as well as market orders vs limit orders. Stock exchanges and markets. Stock exchanges are centralized locations where securities like stocks and bonds are bought and sold. Some of the most well-known stock exchanges include the New York Stock Exchange, Nasdaq, the Tokyo Stock Exchange, and the London Stock Exchange. The two primary types of stock exchanges are traditional physical exchanges and electronic exchanges. In this section, we will explore how these exchanges operate, what they are used for, and how you can access them as an investor. Types of investments in the stock market. While stocks are one of the most common forms of investment in the stock market, they are not the only investment options available. Other investment types include bonds, mutual funds, exchange-traded funds, and options. Each of these investment types carries different levels of risk and potential return. This section will define each type of investment and discuss how they differ from one another. We will also explore how diversification can help reduce risk in your portfolio, how to buy and sell stocks. The process of buying and selling stocks involves working with a broker. A broker acts as an intermediary between buyers and sellers in the stock market. You can buy stocks through a traditional brokerage firm or online platforms, for example, Robinhood, E-Trade, and TD Ameritrade. Once you have a brokerage account, you can place orders to buy or sell stocks. This section will explain how to open a brokerage account, how to place orders, and the different types of stock orders, for example, market orders, limit orders. We will also discuss the role of brokerage fees and commissions in the process. How to analyze the stocks. Fundamental vs technical analysis. There are two primary methods of analyzing stocks: fundamental analysis and technical analysis. Fundamental analysis involves evaluating a company's financial health, including its earnings, debt, and management. It also looks at the company's industry and the overall economy to determine if a stock is undervalued or overvalued. On the other hand, technical analysis involves analyzing historical price data, patterns, and trends to predict future price movements. In this section, we will discuss the differences between fundamental and technical analysis, their benefits, and how beginners can apply them to make informed stock decisions. Risk and reward in stock market investing. Investing in the stock market offers the potential for high returns, but it also comes with risks. Stock prices can fluctuate significantly in a short period, leading to potential losses. While there is no way to completely eliminate risk, diversifying your portfolio and conducting thorough research can help manage it. Understanding risk tolerance and having realistic expectations for returns are essential for successful investing. This section will dive into the concept of risk and reward in the stock market, explaining how investors can assess their risk tolerance and develop strategies to minimize potential losses while maximizing gains. The role of dividends in investing. Dividends are a portion of a company's profits paid out to shareholders, typically on a quarterly basis. Many investors seek stocks that pay regular dividends as they provide a steady stream of income. Dividend-paying stocks are often seen as less volatile and more stable, especially for long-term investors. This section will explain what dividends are, how they work, and the benefits of investing in dividend-paying stocks. We will also discuss how to reinvest dividends and the tax implications of receiving dividend income. The impact of market trends and sentiment. The stock market is influenced not only by company fundamentals, but also by broader market trends and investor sentiment. News, economic reports, and geopolitical events can all affect market sentiment, causing stock prices to rise or fall. Additionally, market trends like bull markets, rising prices, and bear markets, falling prices, can have a significant impact on individual stock performance. This section will discuss the role of market trends and sentiment in stock prices, including how to stay informed about news that might impact your investments and how to react to changing market conditions. Long-term versus short-term investing. Investors often choose between long-term and short-term investing strategies. Long-term investors typically buy and hold stocks for several years, focusing on the company's long-term growth potential. Short-term investors, on the other hand, engage in frequent trading to capitalize on short-term price fluctuations. In this section, we will compare long-term and short-term investing, discussing the advantages and disadvantages of each approach and how to determine which strategy is best for you. The importance of diversification. One of the fundamental principles of investing is diversification. By spreading investments across different asset classes, industries, geographical regions, investors can reduce their exposure to risk. Diversification helps ensure that your portfolio is not too dependent on any single stock or sector, mitigating the impact of losses in one area. This section will explain why diversification is important and how beginners can build a diversified portfolio to reduce risk and improve the potential for steady returns. Behavioral finance and the psychology of investing. Investing in the stock market is not about numbers and analysis. Psychology also plays a major role. Behavioral finance studies how emotions, biases, and irrational behavior can influence investment decisions. Fear, greed, and overconfidence can lead to poor decision making, resulting in investment losses. This section will explore the psychology of investing, including common emotional pitfalls and cognitive biases that can affect investor behavior. We will also discuss strategies for overcoming these challenges and making more rational investment decisions. Common mistakes to avoid in stock market investing. For beginners, navigating the stock market can be challenging, and there are many mistakes that new investors make. These include timing the market, investing based on emotions, neglecting research, or failing to diversify. Learning from these mistakes is crucial for becoming a successful investor. This section will identify the most common mistakes made by beginner investors and offer practical tips for avoiding them. We will also discuss the importance of patience, discipline, and continuous learning in stock market investing. Conclusion: the stock market offers exciting opportunities for investors, but it also carries risks that must be understood and managed. For beginners, the key to success lies in educating oneself, understanding the basics of how the market operates, and developing a clear strategy that aligns with personal finance goals. By staying informed, diversifying investments, and avoiding common mistakes, beginners can gradually build their knowledge and confidence in stock market investing. With time and experience, you'll be well on your way to becoming a proficient investor and participating in one of the most important aspects of the global economy.